I appreciate that. When you get to be 87, people stand and applaud at the start because they're not sure whether you're going to be around at the end.
Fees matter. Buffett, in his 2013 letter to Berkshire Hathaway shareholders, he wrote that his will recommends that most of the cash that goes to his family be put in a low-cost S&P 500 index fund.
To consistently buy an S&P 500 low-cost index fund, keep buying it through thick and thin, and especially through thin.
To prove his point, he bet a hedge fund manager that he could beat him by simply investing in the S&P 500. Warren Buffett made a bet in 2007 with Protege Partners, a New York City money management firm, by investing in the S&P 500 index fund versus actively investing in 5 hedge funds or funds.
Outperforming the hedge fund index, outperforming the S&P through the month of April for the first time in 10 years.
Yeah.
Is the bet that you made one that could reverse itself for the next 10 years, given that trend that we're starting to see?
It's very easy to grasp the word could. Could hedge funds beat the market over the next 10 years? Of course. Anything can happen in markets.
The bet was for 10 years and its outcome was to be measured on a basis net of fees, costs and expenses. Buffett chose to invest in the Vanguard Index Fund, which tracks the movements of the S&P 500 index. As a result, its performance significantly outperformed the 5 fund of funds of its arrival. The S&P 500 had a performance of 125.8% after 10 years when all fees were included, compared to the 36.3% performance of Protege Partners' actively managed investments.
The world's richest man just won a 10-year wager that he had with a top hedge fund manager. Warren Buffett bet a cool $1 million that his S&P index fund would perform better than a group of funds selected by that fund manager over a decade of...
In a letter to shareholders in 2017, he mentioned that the stakes were all about fees, which are crucial to the performance of any investment. His advice to investors: when trillions of dollars are managed by Wall Streeters charging high fees, it will usually be the managers who reap outsized profits, not the clients. Both large and small investors should stick with low-cost index funds. Subsequently, at the same Berkshire Hathaway shareholder meeting in 2020, he started: for most people, the best thing to own is an S&P 500 index fund. Welcome to Invest with Jiri channel. Today we'll look at the reasons why investment titan Warren Buffett recommends not worrying about anything and simply getting rich by investing in the broad S&P 500 index. In the video you will learn the answers to questions like: why is the S&P 500 index such a powerful tool? How much can you earn by investing in S&P 500? Why low-cost index funds could work for you? How does professional portfolio hamster Mr. Gox trade? Why is the performance of active portfolio managers so poor? If you are not already part of the Invest with Jiri channel community, click subscribe and ring the bell so you don't miss any of my other videos. Why is the S&P 500 index such a powerful tool that investment titan Warren Buffett recommends it? The first and key factor is its representativeness of the US stock market. The S&P 500 tracks the performance of the 500 largest and most liquid US stocks, which includes a variety of industries and sectors. This diversification helps to reduce the risk associated with a particular company or sector and hedges investors against fluctuations in individual stocks. An important consideration is the long-term performance of the S&P 500. This index has historically delivered remarkable returns and the long-term average return has been attractive to investors. Warren Buffett himself emphasizes the value of long-term investing, and the S&P 500 represents an easy way to access these returns. If a company doesn't grow as quickly as its peers, it could eventually fall out of the S&P 500 index and thus out of the ETF's holdings. Another advantage of the S&P 500 is its low-cost structure. Warren Buffett is known for his criticism of the high fees associated with actively managed funds and therefore prefers to invest in index products that have lower costs. The S&P 500 also offers liquidity. Investors can easily buy or sell shares in an ETF that tracks this index. This liquidity is important for those who want to maintain flexibility in their investments. Simply, liquidity is the ability to sell or buy at a good price without unnecessarily slips. And best of all, many stocks in the index pay a regular dividend. Dividends increase your yield by an additional 2 to 3% per year. Approximately half of SPY's returns, which is probably the most widely used ETF replicating the S&P 500 index, since its inception in 1993, have come from dividend payments. Buffett wrote in that 2013 letter to Berkshire shareholders, "The goal of the non-professional should not be to pick winners, neither he nor his helpers can do that, but should rather be to own a cross-selection of businesses that in aggregate are bound to do well. A low-cost S&P 500 index fund will achieve this goal." In summary, Buffett recommends the S&P 500 for the ability to provide diversification, attractive long-term returns, low costs, liquidity, and ultimately dividends. All of these points are key factors for successful long-term investing. This does not mean that the S&P 500 index does not have declines. Since the S&P 500's inception in 1957, it has faced countless corrections, downturns, and crashes. Given enough time, however, it's been able to recover from every single one, and since its inception, it has earned an average rate of return of around 10% per year. That's something like 7% when inflation is factored in. How much can you earn by investing in the S&P 500? I've discussed the power of simply investing in an index ETF like SPY in several videos focused on practical calculations. Check it out here. You'll need a long enough investment horizon, compound interest, and an average 7% appreciation, including accounting for 2% inflation. Just for a quick example, how to reach $1 million in your 60s. Put away $100 a week in SPY starting at age 20, and at 60 you have $1,049,000 in your account. I'm counting on the 7% average appreciation that the S&P 500 offers its investors over the long term, adjusted for inflation of course. I think that's proof enough of how powerful compound interest can be. Why low-cost index funds could work for you. Buffett was actually one of the first to say out loud that active fund managers have a terrible track record. Standard & Poor's, which has tracked the performance of active managers for more than 20 years, said in its 2022 report, after fees, 84% of active managers underperformed the benchmark after 5 years, and 90% underperformed the benchmark after 10 years. This is effectively trading on the basis of chance. The performance of actively managed funds is so bad that Standard & Poor's said in 2019 that the performance of active managers was worse than would be expected from luck. I guess I would liken it to Mr. Gogs, the professional portfolio hamster. They put to buy and sell buttons in his box, and his performance was better than the most portfolio managers of actively managed funds. Gogs the hamster became an internet sensation. He has gained unprecedented popularity on the internet with his unique way of trading cryptocurrencies. On the Twitch platform, you could watch him running on the intention wheel and then quickly deciding whether to buy or sell cryptocurrency worth approximately 20 euros. His success rate surpassed many traditional financial experts. Why is the performance of the active managers so poor? Fees, fees, and more fees. These reduce above average returns.
Because costs really matter in investments. If returns are going to be 7 or 8% and you are paying 1% for fees, that makes an enormous difference in how much money you have on retirement.
Frequent traders are another problem, increasing the likelihood of errors and thus higher tax burdens. Last but not least are the same information channels used by large institutions. There is no competitive advantage and everyone has the same information at any one time. Would you rather trust your banker or the renowned investment titan Warren Buffett? I would choose Buffett. I understand it's not always easy to navigate the world of investing, but if you had to take one thing away from this video, I'd say keep it simple, stupid. If you're a long-term investor, don't look back on anything. Make money at your job and invest some of it in the S&P 500 index via the aforementioned SPY ETF. Your performance will outperform most would-be investors many times over, and you will get a good night's sleep. Any fluctuations in the markets will only give you a better price at which to buy your future. Fingers crossed. If you learned anything new, please give the video a like and I look forward to seeing you next time. Have a great time and keep investing simple.